Good day, fellow investors. There have been many comments on Adobe. The stock is down a little bit, but is it a great business so that it justifies buying this dip and enjoying long-term compounding results? If we look at the stock price, it has seen a few, let's say, crashes each earnings report over the last year. And now on the last tepid outlook for 2025, not the 20% growth people were expecting, but just 10%, which is still growth, which is still a good business if it's growing. Now the stock reacted again. And if we look at what's going on, so revenue lower than expected, disappointing outlook, and the stock also declined on the trading and is down more than 24% over the last year. If we look at the investors meeting that they recently had, so they are just projecting 10% growth going forward. This is also something we'll discuss. Generally accepted accounting principle returns and non-GAAP returns, which makes a big difference into earnings, will also make a valuation. But if I look at things, this is the difference. So 16 versus almost 21. For me, that's a huge difference in earnings. And keep in mind, this, also Warren Buffett says it, these are real earnings. These are not. So watch always that. And we'll explain also why. Now, when it comes to the business, they have been growing and they are constantly expanding what they are doing. Of course, now the key issue is their AI. When it comes to great businesses, we have to ask ourselves, what's the moat? And if I look at Morningstar, they say they have a wide moat, but I'm looking at AI, I'm looking at constant innovation, constantly changing environment. So from that perspective, Adobe's moat are, yes, of course, switching costs and network effects. However, there is this subscription burden that's pretty significant. There is competition. AI, from what I see, is very smart. Thus, that might also be a factor. And then if we have a real recession, that would also remove this heavy subscription. That is also something that might affect the company going forward. So we go to our free intrinsic value calculation template. You can download it in the link in the description below on my free course. You can also check the video explaining everything. And here we have Adobe earnings per share, let's say 16. They have no dividend, thus the dividend payout ratio is 0, which removes the present value of the earnings. All the earnings are reinvested for buybacks, thus growth. So we have now 10% growth. There is some buybacks. And let's say that earnings grow at 10%. Oh, let me put here 12 and then 8% longer term. And then if we go to a valuation, future 2034 valuation of 15, then the intrinsic value, if I want a 10% return, is 221. Let's go to the second scenario. Let's be a little bit more exuberant. Let's put 13% growth, 12% growth, and then a 20 valuation at the end of the story. And then, only then, we have, let's say, the current stock valuation close to the stock price. But this is 10 years. I need to project 10 years to get a decent return. Well, where in 10 years from now the stock might hit 927. So that is a little bit, let's say, exuberant. Let's look at the margin of safety. If things go wrong, and this might not happen over the next decade, but this is investing, and let's say that just in 2 years the situation is bad and the market starts projecting this 4% growth, and let's put here, I don't know, a P ratio of 12. Even Apple was trading at a P ratio of 10 a few years ago. So then we are still far from any kind of margins of safety. So for a 10% return, we are still far. If I expect a 6% return, then 5-6% is what can be expected from Adobe, but we always compare things on our comparative table on the 10%. I have to update here and then the prices will update. I'll do it on the value investment course before this video is up, so you can download it with the updated prices. And then we can discuss also this discrepancy in earnings. For me, this is huge because stock-based compensation, that is a real cost because they are giving shares to management and then management is selling shares and they are spending that money on buybacks. So this is a real cost in cash for the company, but they are saying it is not. Where's the logic? I don't know. Maybe my IQ is not enough for understanding this. However, this is generally accepted accounting principle, is reality. Don't get confused by this. This is totally wrong and misleading. Then also on the moat situation, capital expenditure is very, very low. I don't understand how are they positioning themselves when all the other CAPEX AI hyperscaler are planning to spend 254 billion in 2026, while this company is spending 183 million for what they are doing. There is also this risk of AI. Will they constantly be able to innovate to keep that market share? I think that we cannot say that Adobe's business is rock solid. The churn rate in a good economy is still around 10%. 10%, I have also bought Adobe 2 years ago for my editor, and she simply said that she found better editing video software for much lower prices. So that is something that there is always so much competition, AI, huge competition, and it's simply hard to see that they will be able to scale that network and marketing position that they have now. It is possible, but simply the risk and reward at current prices is not for value investors. Value growth is an essential component of value when it comes to that. So if I can find a growth stock at the right price, we'll buy that, no worries. However, Adobe simply does not convince me as other businesses. Perhaps Amazon might have a bigger moat, but that's something we'll discuss when we dig deep into the Magnificent Seven in the next video.